Yep. All right. Thanks for coming, everyone. I appreciate you making the time. And my name is Reed Myers. Hopefully, we'll have some good information for you, some educational material. Today's webinar is going to be a little bit more advanced than ones we've done in the past. As always, I'll try to this digestible for different audiences. It's just first coming into passive mortgage investing space, as well as ones that have been exposed to it for many years. So our main topic today, we're going to be talking about private mortgage funds. And we've got some great guests here with us. We've got Nicole with Madison Trust. Nicole is the Senior Strategic Relations Advisor, I believe. And then we also have Ian Robertson, Sales Team Lead, both at Madison Trust. Madison Trust is a self-directed IRA custodian advisory type company. Would you call it, Nicole?
Yep, self-directed IRA custodian.
All right, great. Yes. Yeah, we've got some mutual clients and we've done business together in the past. Yeah, we're fortunate to have them on here to lend their expertise in their world because it directly correlates with what we do in ours. So we'll go ahead and get started. Of course, we've got some disclosures here. So this is not an offering. None of this is here meant to represent any kind of legal or tax guidance advice. You should always consult your financial advisor, tax attorney, CPA, etc. This is mainly educational content, educational in nature. Just a little bit background on Reed Myers. Obviously, owned the company for almost 20 years now. We're a family company. I was actually born in Hawaii, which is kind of why I'm back here now, but I actually grew up in the Carolinas. I got first started in real estate as an investment analyst for a real estate investment trust. And basically kind of my first foray was into development, retail repositioning, some horizontal land development, things like that. I was also a part of the capital investor team on that. After that, I actually got involved with our family company, Myers Capital, who my father started in the late 90s, and basically came on board actually thinking it was temporary. It was actually right around the Great Recession, a little bit before that. And it just kind of spoke to me and it connected with me as a young adult and just been doing it ever since. So love it. I love everything about it. That's basically my expertise. So our company, Myers Capital, of course, has been around for a long time and just, of course, had different licenses. I have one time was actually going into becoming an appraiser. So I got my license there. I don't have it anymore, but I always feel like these things give us better rounding, especially if you're in the real estate world. There's so much to learn, so much about it that you can never stop pursuing new skills. And all it does is make you a stronger professional. So been very fortunate with that. Just again, some small items. We've been featured in different editorials, mortgage news magazines here locally with Pacific Business News. That one was over 10 years ago, so a little bit younger there. And then our company. So basically Myers Investment Group, we have two companies. If you're not aware, Myers Capital is our mortgage company. So that's where we work with borrowers, real estate investors, developers to help them with their mortgage financing needs. And then we have Myers Investment Group. This is our capital management company. This is primarily what we're going to be talking about today. What we do is basically provide real estate backed investment opportunities, aka a mortgage. And these are primarily for accredited investors who are looking to deploy their capital to basically get very stable, consistent returns backed by real estate. And we'll be going into that quite a bit deeper here. Our mission at Myers Investment Group is really just about helping people. We still help first-time home buyers, for example, helping people acquire, get into real estate, understanding its benefits. And then we brought that same approach over to our capital management side of our business. Basically, it's just meant to taking our expertise to provide ways that capital investors, retirees, and such have a place to go to where they can diversify their portfolio, achieve their financial goals, and really learn, get involved in what we're doing. I'm always enjoy sharing what we go through every day so that they can be a better investor themselves. And that's very important to me. All right. So traditional investing, basically a lot of our audience, I would gather to say, is experiences some way with real estate, and they're probably exposed in some way, shape, or form, either through 401ks in the stock market. So in a way, we'll define it more, but in a way, it's almost a marrying of the two, where you can invest. When you invest in the stock market, it's very passive, right? Give it to your financial advisor, or you pick out your own stocks, build your own portfolio, whatever it might be. But you're pretty much just dependent upon what the markets are going to behold for you. Rental properties, a little bit more on the active side, even if you have property managers. And there's pros and cons to everything, right? Some of the biggest cons that we see with owning rental properties, and nothing against it, because a lot of our investors, and myself included, have done well. We've learned about real estate, and maybe we built a lot of wealth through our rental properties. But it can be exhausting. You always hear about like having a part-time job. And this is meant to be a good combination of both of these, both in passive nature, as well as still being involved in real estate that you know and understand and trust as a wealth builder, but being able to participate into that area as a passive, playing more of a passive role. Okay. So if we want to organize what is passive mortgage investing into a category, you would categorize this as income focused. So of course, we talked about this is backed by real estate. It provides consistent monthly or quarterly distributions, basically income, interest income. And its big claim to fame is capital preservation. And this is completely by using the collateral of real estate to protect your principal. That's your buffer to your downside. There's always going to be some sort of value, innate value in real estate, as we all know. Of course, real estate does fluctuate as well, but we'll talk about how we minimize the risk in those types of standpoints. Diversification, this provides a good opportunity to diversify your portfolio away from public markets. And I never recommend anybody go all in on one category as well. It's good to be spread out and good to have diversification, but we can even further diversification, as we'll talk about today, within the passive mortgage investing space. And as we discussed, this is basically a passive investment. So you have a mortgage. A mortgage is basically a guarantee, well, not a guarantee, but a commitment and an agreement between a borrower that he's going to repay back this loan. And the big differences between just a promissory note or unsecured loan, of course, is collateral. And in our case, we're taking real estate as collateral. So with like any mortgage, most of you have mortgages or had mortgages in the past, you make interest payments. We're just on the other side of that coin now. So you as an investor can participate in those interest payments that are being made by the borrower. Of course, these are all secured by real estate, paid monthly or quarterly, and then of course, very little active management. Okay, so I'll just touch on a couple points here. Professional management. So what does that actually mean? So we don't just come out and put these mortgages together without having systematic approaches, and this is called underwriting. So underwriting is where we look at the details of the whole transaction, from the borrower, the collateral, the credit, what's called the exit strategy, how is the borrower going to exit? And all these factors come into play determining the risk on the deal. And when we underwrite it, we're going to look at, well, what is the risk versus what is our reward, right? So there are a lot of loans and lenders in this category that really shoot by the hip. Our background has actually been more on the conventional lending side. So we actually take that experience and apply it in this private mortgage world. Now, the guidelines are easier in one sense. We're not looking at somebody's income and actually calculating debt to income to determine whether or not we're going to lend this borrower money. There's other factors that come into play. The borrower's experience, the collateral, what are they doing with the collateral? What is their business strategy, right? What is their liquidity? How much cash do they actually have on hand? What is the true value that the borrower and this property actually has? And that's a little bit of art, a little bit of science, but we pride ourselves on quality underwriting. If we ever have to err on turning down a loan request because it doesn't fit our box, we'll do that. Short of issuing a loan that we feel like we need to issue to deploy capital in order to get returns going and our portfolio filled, we'd rather just say no and say, look, we passed on this deal because it just wasn't the right fit for us. So that's very important, how we underwrite deals. All right, so private mortgage funds. So we talked about kind of what is private mortgages generally. There are different ways to deploy capital in this space. So one of them, a lot of our past webinars, we've talked about direct mortgage investments. We've never really gone into a lot of detail in regards to private mortgage funds, how they're structured. So here's kind of a basic template. So a private mortgage fund, typically this is set up as an LLC or a partnership. And when you invest into a private mortgage fund, you're actually buying shares in that. Much like you would buy shares in publicly traded securities, you're buying shares in this ownership structure. So you are actually a part owner in this company. Now the company will have a manager typically. So a manager is the one making all the decisions, right? And this is usually maybe also called the sponsor. So this is typically what we do, right? Managers will decide when and where to appropriately deploy capital. And our job is to manage that capital, make sure our investors are their principal secured, making sure we're deploying it on quality loans. And that's basically loan origination. There's also a lot of other management responsibilities, such as keeping the books, working with our CPAs, working with our fund administrators, and basically making sure that shares are allocated appropriately, making sure everybody is earning their pro rata share, managing redemptions. Redemptions is where an investor may say, put this much money in, and now I'm past my lockup period, which we'll talk about later, and I would like to take out some principal, or I would like to take out some of the interest that I've earned, right? And that's kind of a big basis of what we're going to talk about today is from a retiree standpoint, how can you actually supplement your income or live off this income that you could have in this investment space? So like we talked about, basically the interest, the income that the fund creates basically flows through what's called a waterfall. A waterfall, all investors, the limited partners actually receive their portion of it. And every fund is different. So we're not talking about any specific fund right now, but there is usually some sort of waterfall or split where what the fund creates will then trickle down to the investors. So it's always important to understand from an investor standpoint, if I'm putting on my limited partner or investor hat, is how is this waterfall structured? How does that benefit me? Are there any conflicts of interest between me and preserving my capital and the manager? And, do they have experience in this space? It's all very valid questions that you should always be asking. With a business, right? You're always going to have expenses. So in this case, most funds will incur expenses such as legal, accounting, CPA, tax work. Many of them will also have fund administrators. This is a little bit different from an actual CPA. It's usually meant to kind of supplement and work alongside a CPA, and they handle all the daily accounting, the share distribution, the inflows and the outflows of capital inside of the fund. And they work very closely hand in hand with usually a fund's CPA. Okay, so we touched on waterfalls, so we'll flow here. All right, so I always like to touch on things that investors should be thinking about, like frequently asked questions, questions that I've been asked personally. And I always like to write these down. What questions have I gotten in the past? What questions, how can I get ahead of this to be able to be more forthright with clients and expectant of what they're going to ask? So you can never stop learning, right? So it's always good to listen to your investors and not to mention do your own homework, right? So here's some common questions and definitions that are good for investors to understand. Number one is an initial lockup period. So a lockup period, as it sounds, well, your money's locked up, right? This is most commonly correlated with maybe CDs, right? I'm going to put my money into a 6-month CD or a 12-month CD or a 24-month CD. This is very similar to that. So many funds will have a lockup period. Now, depending on what kind of fund, today we're going to be primarily obviously talking about private mortgage funds, but we're also going to do some comparisons to other types of funds, perhaps real estate equity funds, where they're actually acquiring real estate, not lending on real estate. And it's important to understand the differences that they have. So lockup periods in our world, most private mortgage funds are deploying capital on short-term mortgages. So these are typically 12, maybe 24-month loans, so relatively short in nature. But even with that, most funds will have some sort of lockup period. So what that means is whatever you decide to invest, that money cannot be easily withdrawn within that lockup period. Now, I have seen some cases where funds will allow it. There might be a slight penalty, meaning the same way you would if you invested money into a CD. You would see, well, if you request to redeem your money out early, they're just not going to pay you the rate of return that they said they would, right? So that's all written out, but that's important to understand because I always tell people, even in short-term investments like this, you don't want to put money into these types of investments if you're going to need it anytime soon. This should be looked at as long-term investing. But with that being said, these are semi-liquid investments. So we'll kind of talk about that. Advance notice requirement. So let's just say you've gone beyond your lockup period. Advance notice requirements are basically saying that I want a redemption, right? A redemption means I want to take out my principal, either all of it, part of it, or perhaps even your interest. So most of these funds, the way they're structured is you will earn interest and it'll accrue. And a lot of times you'll have options. You'll have an option to receive that, let's just say quarterly interest income, right? At which point your principal is actually just remaining at the original principal that you got, but you receive the interest. You can also typically reinvest your interest. So this is called reinvested distributions. And basically that can allow you to compound. So when you request a redemption, you can either choose, again, depends on the fund structure, but you can choose to take out either interest that had already been in there that you've already earned, or you can choose to take out your principal, right? So advance notice requirement simply is fund managers will many times, depending on how much you're asking for, need a certain amount of time to get that money out to you. Now, they all vary, right? So we don't have any specific number in here, but that's important to understand, right? It's not instantaneous. It's not like selling stocks where you can just get it the next day. It's not as liquid as the public markets, but it's not locked up in very, very long-term tranches the way maybe a real estate syndication deal might be. Some funds, it's worth mentioning, may also have scheduled redemption windows where they say, okay, after the lockup period, you're only allowed to request redemptions during these specific windows. So maybe quarterly or something like that. All right. So I really want to share these slides with all of our audiences here because there's a lot that you can compare. So I'm not going to go through every single line item on this. It's a little bit too much, but I want to pinpoint at least a few specifics. So this chart here, we talk about different features. So diversification, underwriting, risk profile, etc. And what we're doing here is just comparing in a very basic manner private mortgage funds versus direct loan investing or first trust deeds. So in prior webinars, which, feel free to go on our website and look at some of our past webinars, a lot of them have been on direct mortgage investing or direct loan investing. So again, just like anything, pros and cons. Private mortgage fund, the big difference between that and a direct is going to be diversification across many, many loans. So think of it much like a mutual fund, right? We've all probably invested in mutual funds at some point in the past or maybe currently. Mutual funds are built up of sometimes many other mutual funds or sometimes direct stocks or indices. So when you buy shares in a mutual fund, you're not concentrating on just one stock here and there. Your risk is spread out across the entire fund itself. So that's the easy way to think about it. Direct mortgage investing, you invest into one mortgage itself. Either take the whole thing or a fraction of it. So your risk is completely focused on that. Again, some investors prefer that. Some investors prefer more spread out diversification. Just different strokes for different folks. Underwriting is going to be very similar. Risk profile kind of ties into diversification. Investor involvement. So it's worth mentioning that investing in private mortgage funds usually are very, very hands-off. You don't get involved in making the decisions on who we're going to lend to. Do I like this deal or like that deal? You're completely giving your basically focus and trust in the fund manager themselves and their experience and their expertise that they are going to provide the best choices for who to lend to and on what deals. Direct mortgage investing is very much one by one. I like this deal. I don't like this deal. I don't like this deal. I like this deal. So there's more involvement in that stance. A little bit more paperwork. You do have to sign different, at least for us, you have to sign different documents. We assign mortgages over to you that requires notarization. It's less scalable, I guess you could call it, where every time you find a deal to invest in, it's going to run. You're going to get your interest payments. Once it gets paid off, then now you say, great, I got all my principal back. You have to look for another deal, right? Otherwise, your annual yield starts to go down because your money's not earning anything. So again, some investors like that. They like the hands-on nature of it. Some prefer to be on a more passive side and let fund managers do what they're supposed to be doing. So those are the main things regarding these two. On this chart, we're primarily focusing on the differences between mortgage funds, what's called a credit fund. So you will see a lot of news on this right now, and this is not to be confused with private credit involving real estate. So you can go Google it right now, say, what is the private credit industry doing? And you're going to see a lot of bad news. You're going to see defaults. I even read one the other day on Wall Street Journal about they call it a run on the bank. And it's basically, private credit is basically lending to businesses or consumers. And many times there is not collateral back to it. There might be personal guarantees. There might be or maybe UCC filings, things like that, but there's not any hard asset there. It's very much like lending to a business. And unless the business has collateral, like real estate, if it's real estate, it goes into the mortgage world. If there's equipment, maybe there's some equipment there, but the point is credit funds, private credit in general doesn't have collateral, not as secure as real estate, a hard asset. So it's important to understand as you're reading up on these different industries, what's actually going on. Doesn't necessarily, we're a subset of private credit, but we are private credit backed by real estate. So very important to understand. The last column is equity funds, so maybe real estate syndications, as a lot of people call them. This is where they're not lending on real estate. They're not providing mortgages, they're actually acquiring real estate. So this is a very popular way to invest. It's done very well in prior years. It's going through some challenges right now. But again, there are differences between all three of these. The big ones are going to be equity is the first portion in the capital stack to lose any or have any principal loss. Mortgages is going to be what's called lower on the capital stack, which means we're always first in line, especially if we're a first lien, to get back and secure and protect our principal. So I'll show you that on this next slide. One important consideration, obviously we talked about mortgage funds are interest income, right? So as a mortgage gets paid every month, we earn income. Many real estate syndications, they will have income or can have income, but it's derived from tenants, right? Because they're buying the real estate. So it's very much dependent on tenants, what sort of income they're generating. Are they current, right? Making their payments. It also depends on how much money these fund managers are actually putting into the property. So many times these equity funds don't just acquire real estate and sit on it. A lot of times there's some value add approach where they're going to be putting improvements into it, spending hundreds of thousands, if not millions of dollars. So that when it's going through those stages, there are chances for much more reward, but it is inevitable that there is much more risk involved. There's a lot more moving parts of things that can go wrong. And nothing against this category. I've invested in this category in the past, but it's just important to understand for purposes of our meeting today, we're talking about consistency. And then we're going to talk about what happens if stock markets take a dive, right? And how does that affect your retirement? That's kind of the main focus here. So very important. Again, we'll send this to you so you guys can dig into this a little bit more. So this is what I mentioned about the capital stack. So there's this thing called the capital stack. Capital stack is, and a lot of times, if you're not coming from the finance world, you've probably put it together in your head already, but this just lays it out. It's a very common term we use in our world. Basically, we've got a property, right? So in this case, let's say the value of the property is $1 million. Doesn't matter whether it's a purchase or refinance, the value of this property is $1 million. Now, let's just say in this case, this is a purchase. So if a borrower has 40% to put down, so $400,000, that's their skin in the game, right? That's what they've got to bring out of their own cash to buy this property. Now, if that's all they can bring, they're going to need $600,000 in debt, right? By way of a mortgage. And in this case, we actually just threw in one more layer just so you can kind of see how it's spread out, called subordinate financing, second mortgages. Second lien position, right? Senior debt is first lien position. So your 400,000 skin in the game. In this case, if you took a 10% or $100,000 second mortgage, and that was behind our first mortgage of $500,000, makes up the whole capital stack. The lower you are in the capital stack, the less risk there is from an investor standpoint, not the owner standpoint, from the capital investor standpoint, you and I. The higher you are in the capital stack, the more risk there is, and theoretically more reward, right? A lot of people get into real estate, they can do well with it. They can only put 400,000 down and that property can grow in value and they can have a very, very great IRR with tax benefits. But for risk purposes, for principal protection, the most secure section on this chart is going to be senior debt, 100%. So equity, when I say equity is the first piece to lose in the capital stack, if this value drops, and I think I have my next chart. Yeah. My next chart shows if the value drops, what changes in this whole capital stack and who loses. Yeah, and then we've got just some information here about real estate syndications, a little bit more in detail. Real estate syndications typically tend to last for longer periods of time, less predictable income, so doesn't have the consistency as private mortgage funds. All right, so this is a kind of a case study of what it looks like if we were to incur, or this property were to incur, a 15% market decline. So this kind of ties into like market correlation. What happens if the economy goes down? It affects jobs, it affects people making their rent payments, affects people making their mortgage payments. If it's commercial property, the income on the commercial property drops, further accelerating the decline in value. So we always want to be prepared for that from a fund manager standpoint. What happens if worst case happens, right? So in this case, if let's just say a 15% decline, so this $1 million property is now worth $850,000. What happens, right? Well, we're still owed in this example $600,000, still what's owed to us. But what happened to the equity in the property? So that property owner's equity just dropped by 150 grand because a slight value, that's not a slight, it's a pretty big market decline, but it dropped pretty significantly. So if this situation happens, right, and the borrower still had to sell the property, because a lot of times our borrowers are acquiring property with our loans to usually rehab them. They might flip them per se, do value add projects, maybe subdivide, maybe build. There's some sort of exit, say maybe 50% of the time they're going to buy it, they're going to renovate, they're going to sell it. So if they had to sell it in this market, that property owner is going to take a pretty big hit here. But our debt is still secure. We're only owed 600 grand. This property is worth 850, even after realtor fees, things like that. So the first person to get hit is going to be the equity investor or the owner of the real estate. So that's how we really focus. That's the world that we play in. First lien secured debt. We do have occasionally some second liens here and there, but it's a very small part of our portfolio. All right, so I'll just go through this real quick. I mean, the world of private lending, we fill the gap where the banks stop. Banks have tightened lending standards. It's kind of been going on a long time. They've not in recent years been very active at all in the transitory lending market. Transitory is when you're buying a property that's going to undergo some sort of change, right? It could be, like I said, buying a property, adding square footage, rehabbing it, retooling it, maybe buying a warehouse and converting it into residential units. There's a number of different things. Banks don't like to lend in that case. So that's where the private mortgage lending world fills. That's why we're able to charge double interest rates, because the banks don't want to do it. And so we play a very important role in real estate investing to get properties to the point where they're now either valued more or providing more income or providing more housing or whatever it is. So we feel very good. I mean, I like the fact that we can play that role in the real estate market as far as improving conditions in and around us. Whether developers buying and retooling it and reinvigorating into the community, private lending actually plays a very, very big role there. All right, so we're going to talk about here. So this is going to be focused on retirees, okay? So the consistency part of what these investments can provide is really kind of like the golden goose. So we'll show that here. So if an investor has a $500,000 IRA scenario, or IRA, let's just say, doesn't need to be an IRA, but portfolio, and they're getting a 10% return in the stock market, that's historically what the stock market's got 100 years or so. 4% withdrawals. So that's kind of a common boilerplate number that we see where some investors or retirees like to take out 4% withdrawal a year. It could be RMDs, it could be anything they want, but for example purposes, that's what we're using here. So if they had a $500,000 portfolio, they're taking out $20,000 a year, and the stock market continues to do well, that's great. It's going to grow. It's going to be volatile, but it'll still grow, right? Now, what happens if when you start taking out your withdrawals, and you still need to, but your market happens to decline 20%? So right now, I think the other day, like year to date, like we're down like 6% or something like that. So obviously nothing that deep right now, but it has happened. As I mentioned here, in 2000, 2002, 2008, 2009, 2020, and 2022. So very recent years, we've had market declines of that much. So how does that affect a $500,000 portfolio in this example? The next page here, we'll kind of see all the charts. And then if you compare that to, a private mortgage fund returning 11% and you take out a 4% withdrawal rate, it's going to be consistent, right? Some funds are different, but some of them are hovering in this arena, and it'll fluctuate a little bit, but not nearly with the volatility that you'll see in the stock market. And then we'll show one other example of, well, shoot, I'm earning 11% a year. Could I just take out more than my 4% that was originally discussed? And my principal will remain the same. The answer is yeah, right? Because your principal will not reduce, but you're actually able, in this example, to take out all the interest every year if you wanted to, right? So that's the kind of advantage that it can provide with consistency. So here's that formula in a little bit more detail. So stock market portfolio, 10% annual return, you take out 4%. At the end of that first year, your principal balance is 530,000, right? So say, great, well, I still went up and I got $20,000 to live off of or supplement my income. I'm not doing too bad. Say, yep. So here's an example with the 20% decline. So you got 500,000, you still take out your $20,000 because maybe you need that to live off of or supplement your income, you're dependent on it, or it's RMDs. Well, with a 20% decline, your portfolio has now dropped considerably, and it's going to take significant amount of time to recover that. So now the argument to that is, well, I don't sell, right, when things are down, and that's great. Maybe you shouldn't. But the truth of the matter is a lot of our investors do need to take out their cash every year. Maybe they're living off of it. Maybe they have to because they have required minimum distributions. So for somebody younger, being in the stock market, it's not a bad thing, right? It's just one of those things that you have to take that into account based on where you are in life or where you see your cash needs being, right? So you can see here that your portfolio, just from a visual standpoint, everything's going well, your portfolio still grows. If it's not going well and you still take out RMDs, look at the difference here. It's pretty dramatic. All right, and then this just further to the point shows the trend of a portfolio without a drop in the stock market, and then one with a 20% drop, and then the rebound, continued 10% growth. Still, it's going to take a long time to get up here unless we have some big jumps in the market. This is a lot of ground to make up. It's kind of one of those things too about, have you ever heard of the scenario of getting in and catching a falling knife, right? So some people like to buy the dips, right? But if that dip is still continuing, it's going to cut you, right? So it's similar here in that you're just along for the ride. You have to deal with what the market's doing here unless you sold out. And then if you hung on, but you still needed your distributions, it'll come back. It's just going to take time. But this gap here is what's going to affect your retirement. That's the main thing. All right, so same type of scenario. We're just going to apply it to the private mortgage lending side. Okay, so a lot of funds might be returning 11%. Okay, so if they're returning 11% consistently with a 4% withdrawal rate, you take out your 4%, your 500,000 actually grew to 535. That's still getting your $20,000 a year. Say, great. Now, the other option is taking out more than the 4%. Because we're earning you more, or if the fund manager is earning you more, you can opt to just take out the entire amount. And that's a lot of funds are completely optional there. You can take out the money as long as you're past if you're taking out interest, most of the time they'll pay that out just about any time. If you want to take out principal, keep in mind you might be still in your lockup period, so that may not be allowed. So that's in a consideration. But the interest very often is going to be allowed to be distributed many times whenever you want. So you say, well, my portfolio will either grow at a higher rate of return, a higher pace, and I still get my 20, or my portfolio will remain flat, and then I can live off of even more than double of what I would have if I just taken a 4% withdrawal. So, and then here's the two basically side by side, apples to apples, private mortgage fund, perhaps earning 11% with a 4% withdrawal rate per year, and then your stock market portfolio with a potential 20% decline, which can happen and will happen. It has happened historically more often than we'd hope. So very important thing to keep in mind. If you're looking for consistency, many times private mortgage funds can provide that for you. All right, so a little bit about us. Loan to value, that's kind of what I referenced earlier about the capital stack. Our average loan to value across our portfolio is about 50 to 60%, so right in line with what I showed you. Of course, it's all backed by collateral. We're underwriting the borrower, underwriting the property, getting third-party appraisals, third-party inspections, etc. So we keep everything in line. This is all basically underwriting. We do have third parties that help us with basically the operations of our company. Securities attorneys, real estate attorneys, any real estate litigation attorneys, if we have to go to default, fund administrators, which help work alongside the CPAs to help keep accounting up to date, and basically having third parties overlook our shoulder to make sure everything's on the up and up and provides checks and balances. All right, so now we've got Nicole. Sorry, Nicole's a little long.
It's our time to shine, Ian. Let's go.
Your time to shine. All right.
Well, thank you so much for, that valuable presentation. I think that a lot of our clients, as well as your clients, have a lot of things to look forward to with your organization in the future. Now we want to get into more of the self-directed IRA side. My name is Nicole. I am the Senior Strategic Relations Executive, a part of our sponsors team at Madison Trust. And I am joined by another leading member of our team here, Mr. Ian Robertson, who is our sales team supervisor. Today, we will be introducing self-directed IRAs, also known as SDIRAs, and how investors can use retirement funds to invest into alternative investments, such as real estate, private lending, promissory notes, precious metals, and so much more. So we do want to get started on really what defining a self-directed IRA is. An SDIRA is all about you as an investor. You are able to take control of your retirement income and place it into investments that you are passionate about. It's a tax advantage or tax deferred strategy. And Madison Trust does serve as the vehicle for any investor who's interested in diversifying their retirement portfolios into alternative investments of their choice. So you may have heard of what self-directed IRAs are in the past, but we want to really explain to you how they work at Madison Trust Company. So now we'll go into a little bit about our open fund invest model. So we really do have dedicated teams here that strive to make the process as easy and seamless as possible. We focus on 3 easy steps for every single investor, which is open, fund, invest. Any client would start by opening the IRA account. They would complete an online account application or work directly with one of our account executives, one of them being Ian. Ian will ensure that the client completes the IRA account application in 10 minutes or less. As long as the client is ready and they have their photo ID and beneficiaries designated, they should be able to complete that fairly quickly. The onboarding process that Ian will highlight is really going to assist any investor answer basic questions such as the type of IRA account they plan on opening, how does a client plan on funding the IRA account. So that will be all outlined in the account application. After the account application is completed, the clients will receive an account number within 24 hours. And the next part is it's time to fund. So there are a few ways that clients really can fund the IRA account. Client can start by doing a direct rollover from a 401k plan or transferring funds from an existing IRA plan at Charles Schwab, Fidelity, or any of those custodians. Or lastly, a client is able to proceed with an initial contribution based on their age limit and the tax limit for the year. We do accept 401k or 403b funds into Madison Trust accounts. We also accept thrift savings plans as well. The IRA account types we hold at Madison Trust Company are traditional, Roth, SEP, and simple. We also accept inherited accounts at Madison Trust as well. During the funding process, we do have a dedicated team, which is our transfers department, that will be able to assist the client as well as work with the former custodian to obtain funding into the Madison Trust Company account. And lastly, it's time to really invest for the client. So the client Once the funds have arrived at Madison Trust Company, that's when we will work with the investor to ensure documentation for the entity they choose to hold within the IRA is completed with Madison Trust titling. We need to ensure everything is titled on behalf of the Madison Trust account and not the client personally. The IRA account is the one that's making the investment. And, we do operate as a passive custodian. So when it comes time to invest, we hope clients' IRA accounts grow, and definitely more than what they see performing in their standard 401ks with their qualified employers. However, we're not able to provide any tax, legal, or financial advice regarding the investments that they choose to place. So much like Reed, it's recommended that investors perform their own due diligence when placing investments through their Madison Trust IRA account. The next piece here, I'd like to discuss more of the benefits of working with us at Madison Trust Company, as well as overall as a self-directed IRA. As Reed discussed earlier, Myers Investment Group specializes in real estate financing solutions, including bridge loans and construction financing. They do work with investors to help them access capital and structure real estate opportunities. Madison Trust, though, provides the self-directed IRA platform to allow retirement funds to participate in those investments. So first is portfolio diversification. Self-directed IRAs offer investors the ability to diversify beyond traditional stocks and bonds, from private lending to startups or real estate projects. Our investors can explore a broader range of opportunities. And through collaboration, Myers Investment Group helps structure real estate financing, while Madison Trust provides the self-directed IRA account, enabling retirement funds to access these alternative investments. Next is really hands-on investing. So as I said before, investors have full control over the investments. The account holder decides the investments they would like to place through the IRA account, not a broker. So all different types of alternative investments can be held through a self-directed IRA, and Madison Trust Company does empower the investors to pursue these alternative investment opportunities, while Myers Investment Group supports the evaluation and the structuring of real estate financing options. And lastly is the stability. So investors are able to hedge against the stock market volatility by focusing on alternative investments with a potentially higher and steadier income stream. So such as real estate or private lending, as Reed mentioned earlier in the presentation. Madison Trust Company does enable retirement fund flexibility, and Myers Investment Group provides access to financing opportunities that support those strategies. And the next slide, I am going to hand it over to Ian to talk a little bit more about our teams here and the client support that every single investor receives here.
Thanks, Nicole. So why work with Madison Trust Company? For one, we work closely with Reed and his team, and so the process is incredibly streamlined at this point to onboard you, get your account funded, and process an investment as you see fit, if that's a route that you want to go. Beyond that, though, really it's about having access to a support system that understands self-directed IRAs, that understands the nuances that come along with this, things that you may not consider as you're first entering into this space. And so you have access to our team. We're readily available during business hours. You don't have to wait on hold for hours on end or wait weeks for things to be processed. Standard processing times that we strictly stick to with everything that we do. And again, stick to our responsiveness as well. We always make sure that we're well staffed and well trained to both be able to answer your questions and answer the phones to begin with. Beyond that, our fees are streamlined. It's straightforward. We are not charging based on the value of your account. So we're on your side in hoping that your account grows in value over time as you are. So we're well aligned in that way. We're simply charging a flat maintenance fee for the account and the services that we provide as your custodian for the IRA. And like I mentioned, our team is well trained. We have about $6.5 billion under custody at this point, clients in all 50 states, credible reviews across different platforms. So don't take my word for it and Nicole's word for it. Look us up online and you can read what people think about us and the experiences that they've had firsthand with us.
Yep, absolutely. And Ian did touch on our fee structure. So every single client at Madison Trust Company does have $139 per quarter fee structure. If you joined us today and you are interested in signing up after this call, you will receive $129 per quarter fee structure, and you will also be receiving $125 onboarding credit, which will waive your account application fee, as well as placing your first investment fee with Myers Investment Group. So I encourage you to take the best advantage of that offer that you can. Not every single client gets that here at Madison Trust Company. We value the relationship we've built with Reed and his team. And again, if you have any questions at all after this call, my name is Nicole. We have Ian on this call as well. You can contact us. That's our information right there. Feel free to jot that down, and definitely looking forward to working with you.
Thanks, Nicole. Yeah, I really appreciate it. That's really good. I didn't know you guys were that big with $6.5 billion under management now.
Mhm.
It's very impressive. But yeah, like there's nothing formal between us and Madison Trust. It's pretty much just we have worked together in the past. We've liked working together. They've taken care of my clients, and I've vice versa. I've sent clients to them. They've just been a very professional team, just provide good hands-on service. Worked with a lot of different ones, and there are good ones out there. So some ones that they just don't really, I don't know, it doesn't really align as much with how I like to take care of my clients. So yeah, you guys have
Yeah.
a great team, a great system over there. Really enjoy working with you guys.
Thank you. Yes. So I am Reed's prime point of contact at Madison Trust Company, and Ian is the one that really onboards the clients. So Ian will make sure that you are taken care of if you follow up after this call.
I didn't go into too much detail what kind of loans that we're actually doing, but we lend in about 42 states, a good maybe 60 to 80%, just depending on the month of our portfolios in Hawaii. Is our backyard is where we get most comfortable. Well, with that being said, we don't pass up great opportunities in other states. Specifically, we like to focus on the Northwest, New Mexico, Texas. We like the Mid-Atlantic through the Southeast. Big part of it is our clientele base. Going back for many years, that we had our original office locations in Virginia and in South Carolina. So, but I think most of these deals here are, oh no, we spread them out a little bit that I'm going to show you today. But this is residential loan property, great side of Kailua Kona on the Big Island of Hawaii. Hawaii is one of the places where we get a little bit more comfortable with land. We still like buildable lots, generally where there's some residential type component to it. But in Hawaii, majority of the value is in the land. It's completely different than going out to the Midwest or places like that. So we actually had a client approach us. He owned a free and clear lot next to a property where he's building this beautiful custom home as an investment, and he's basically needed a little bit more cash to get it to the finish line. So we took a first lien position against this parcel of land, very good neighborhood, buildable lot, and we appraised it at about 2.2. We got comfortable with that value. We don't always take face value of what comes back in the appraisal. They're not perfect. Appraisals are opinions of value. You can have two appraisers do the same property within the same week, and they come up with valuation differences 5%, sometimes more. You have to understand the markets. You can't rely solely on appraisals. But in this case, we got comfortable with it. Property value 2.2. We lent this borrower 1.43 million, and our investor that owns this is earning 11%. And keep in mind, these are not open opportunities as of right now. I think a lot of these have been taken, but this gives you a sense of kind of what we're doing. So if somebody invested the entire amount, they would be earning $157,000 a year, paid monthly about 13 grand, and that low LTV that we like to see. Condotel. So this one, not land, obviously. Condotel, these are basically what we call legal short-term rentals in Hawaii. Obviously, we're a vacation destination, so you see a lot of these. providing a lot of value to tourists that come here that they want to get around the hotel experience and they like the kitchens and like to feel it more like home. So this is a big part of our economy and a big part of our lending business. So this is existing client, one that made us more comfortable pushing the LTV, as you can see. Number two, he's already shown a track record of owning a property in this building and performing on it and executing his business strategy. So got comfortable pushing the LTV a little bit more, but still we got a nice 11% return on this. And I think this one we're on month maybe 9 of 12, and he's been making every single payment on time. So very good. Switching across the world here, we go all the way over to Newport News, Virginia. We had a client approach us, never worked with him before, but he had a great track record, a great schedule of real estate that he owns, nice portfolio. And he was trying to reposition this mixed-use property into kind of an event center with multifamily apartments on one side. And we came in and lent him 1.136 million on an after repair value of 2.3 million. So a couple moving parts here. After repair value is what the value is going to be after the work is done, right? We didn't lend him the 1.136 million out of the gate. We actually held back, and it doesn't show this here, but we held back in what's called a construction holdback. I think it was about 450,000, somewhere around there. So we don't just front the money to them when they're going to have to go do work, because we like to know what our going in risk is. And that's based on the first part of the loan compared to the current value, as is value. So in this case, if you take off 400,000 off of this, so you're at about 700-ish thousand, that's really our day one exposure. And we appraised the property at 1.5. So that's why our loan to value is actually only 44 out of the gate. And then once his project is done, by the time it's done, it's worth this. And we would have deployed to him the entire loan amount size. And our loan to ARV is still very nicely kept at 49%. So really good deal, a lot of moving parts. We got a very nice return on this one, 12%. And I think the borrower is 1 or 2 payments in. So nice track record and very nice yield. All right, so heading back to the Big Island. This is a returning client, so felt comfortable with giving him a little bit better rate, as you can tell, but it's all meant to be taken with a grain of salt. You don't always want to go for the highest yields, and you don't always go for the lowest. You want to understand what you're lending on and why, right? So sometimes the interest rates are a little bit of a negotiation between us and the borrowers, but we have to stick to our guns. We know where we're comfortable, where we need to deploy capital, but we also like to reward borrowers with good deals, with good track record, existing clients, things like that. It's about relationships as much as it is about making money, right? It's not all about making money. So in this case, very similar. I think we held back around the same, around 400,000 on this. So our day one exposure was 48%. After the property he's building, this is actually a GC, general contractor on the state or on the island of Hawaii, and he's building out a home. And once everything's done, it's going to be worth about 54%. We're going to be lent or exposed ourselves to 54% of the after repair value. And we got a nice 10.4% return, monthly payments, 8666. All right, and last one, back over. I think this is why our marketing manager did this. It kind of show a little bit of both Hawaii and then show the work that we're doing on the mainland, as we call it. This is one actually we closed not too long ago in Philadelphia. This was an owner user, not to be confused with primary residence. It's not where they live. It was a mixed-use building. His business occupied the building. And he had a chance to buy the property from the landlord, and that's what he did. So basically he came in, he put down about 40%, and we came in and lent him the rest. And we're getting an annual yield of about 11.6. And this one's a shorter term, so 6 months. So some of our loans can go shorter, and it's good to kind of have a mix, right? We don't want all 12-month loans, and we don't want all 3-month loans. Sometimes we like to be in and out. Sometimes we like to go in the middle and pick something like 6 months, and then give us a chance to see that they can perform, and then we can extend it out from there. So we like to work with, there's a lot of maneuvering in how we structure deals. At the end of the day, it's got to make sense for the borrower, and it has to make sense for us and our investors, because our job as a fiduciary is to, manage the capital appropriately, deploy it appropriately, and have a win-win situation. So yeah, that's pretty much it. Nicole, I think what we're going to do, right, is after everything's done, we'll just send out an email with all of our information, and maybe we'll have some links in there if anybody wants to schedule anything. Feel free to use those links, or either way, you can send us an email, it brought some value to you folks, and appreciate your time.
If anybody would like to contact us as well, we have a customized landing page between Madison Trust and Myers, so happy to share that as well to schedule a call.
All right, great. Okay, thanks everyone. Really appreciate it. Nicole, Ian, pleasure.
Thank you. Thank you again.
All right.
Have a good
Take care.
one.
Bye-bye.